Okay, hello. Let's go ahead and get started on the prep document for exam 3. By now, you probably have a good idea of how this all works. The prep document is divided up into 3 sections: the level C questions, level B questions, level A questions. The level C questions are all on the quiz, and they're numbered so that, for example, C1 is the first question on the quiz, C15 is the 15th question on the quiz, and what happens with the quiz is that the quiz is posed as a question, whereas the prep document is prepped as a knowledge statement, because sometimes in the quiz I ask a true or false question, and it doesn't make much sense for me to put the false information in the quiz document. So I put whatever the true information is in the prep document, and then I have the choice of asking multiple choice question or true false question, but at least you know what the knowledge-based item is. Typically during these prep sessions, I go through and I explain all the B and A level questions, or at least the calculation questions, and I just refer you to reading on your own the knowledge questions. Well, chapters 7 and 8 were a lot of knowledge questions. One was the accounting systems, and the other one was sort of the internal control or fraud systems. So 7 and 8 are almost are heavily weighted towards knowledge questions. So there's not a lot of calculation questions I can kind of point out. I will just encourage you to do the quiz enough times so that you feel that you have a good sense of recognizing the questions and be able to answer them quickly. That's your best way to at least getting a passing grade. Here in chapter 7, I don't think I have even one C-level calculation questions, all knowledge questions, but make sure you understand all of them. Same with 8. I don't think I have a single. And the other thing I did different about the document, because a student requested that I put all the C-level questions together, all the B-level questions and all, so that they can study them without having to flip around. So in other words, your process should be to make sure you know very well the C-level questions, and then see how far you have time-wise, starting off with the B, because those are the second most valuable questions. C-level questions are 5 points each, B levels are 3, and then A's are 1. So if you don't have enough time to study, just don't study the A's, because if you get them wrong, they're only 1 point off. Make sure you study the C's absolutely and know enough of the B's to get a good grade. So chapter 8, internal control and cash. Again, no actual calculation. We'll have a calculation in the B and A's. Chapter 9, which was receivables, we do have a couple of basic calculation questions. So let's go through ahead and look at this. So I'm going to focus on C38 and C40. Now you'll notice the one right before it is an explanation of what's going on. So C37 explains C38 and C39 explains C40. Bad debt expense is an estimate of the uncollectible accounts, is used in the period as the original credit sales because of the matching principle, match all expenses with revenues. So what happens is we had 1,000 in credit sales, and it estimates 150 of those receivables will be uncollectible. So here is just a straightforward understanding one of 2 different types of journal entries. The first journal entry is the adjusting journal entry at the end of the month. So in adjusting, if you remember in chapter 4, we went over those. Adjusting journal entry at the end of the month. And this particular one is our estimate. And the reason why we have to make an estimate is because in the same month that we do the credit sales, we also have to estimate the future amount of those credit sales that we won't collect. Now, we don't know the exact number. That's why we use in an estimate. And so just make sure you know the format of this. This adjusting journal entry is debit bad debt expense, and then credit this allowance for doubtful accounts. And this is the very basic one. If it tells you what the amount of the bad debt expense is going to be, or what is uncollectible, you just make sure you know the format. The second journal entry that you need to know on the C level is, if we read C39, some bad English there. The allowance for doubtful accounts is a counter asset account that tracks the estimate of bad debt versus actual write-offs. So what do we have? We have the estimate journal entry, and we have the actual write-off journal entry. Those are the 2 parts of this estimating function that you would need to know going forward. Now, I don't know how many online students are actual accounting majors. Probably not many. So, and that's typical with every class. It's only about 10% in each class that are accounting majors. This is all you're going to need to know. But for accounting majors, just realize this estimating function, this process is used multiple times in accounting for different types of account. We have two journal entries we need to know. One is the estimate at the end of the month, and the other one is the actual write-off against that estimate. And that's all you really need to know. So the estimate is always bad debt expense, debit bad debt expense, credit ADA. The actual write-off is debit the ADA. You notice that here they are. We create the estimate here, and we write off against it here. Well, what are we writing off? We're writing off the AR. Basically, even though we've estimated the bad debt expense, we haven't written down the AR until we actually know that we can't collect it. So that's the sort of the theory behind it. Okay, so we've got a couple of other things here. If we go up to C42 and we look at the ADA balance is $50, end of the month AR balance is $1,200, and the uncollectible percentage is 5%. So this is the other thing that we need to know is that yes, in this C38, I just gave you the number, but the truth is a lot of times we have to calculate the bad debt expense. We have to calculate that number, and it's based upon this ADA T account. And so if the ADA beginning T account is 50, and what we do is we multiply, at least in the first method, or in the C-level method, is we say, okay, if the end of month AR balance was $1,200, and we estimate 5% of that is uncollectible, that ends up being $60. This calculation is actually the ending balance. So what do we need to do? This is our journal entry. This is our adjusting journal entry. This is our estimate 10. So what we need to do is do the bad debt expense of 10 and the ADA of 10. Oops, ADA of 10. So just be aware that we have the format of the estimate, we have the format of the write-off, and then calculating the bad debt expense each month is based upon the beginning balance and our calculation of the ending balance, and then the journal entry for bad debt is based upon what allows us to go from 50 to 60 or whatever the numbers are here. So C42 and C43 are the questions here. C43 is asking you this number. Can you calculate the new ending balance? And then C42, I probably should have reversed these, is saying, okay, if you know the beginning balance, you've calculated the ending balance, do you know what the adjustment is? So those are the two calculations there. So that's the majority. Well, those are the four things, the two journal entries and the two calculations for allowance for doubtful accounts or bad debt expense in this. And then the other calculations in this C level is interest on a loan. So let's take a look at interest on the loan. How much is interest on a 6-month $1,000 10% loan? Well, just remember that the percentage is based upon a full year, and we don't change it we don't change the percentage to match the how many months or how many years. The percentage is always exactly 1 year, and then we figure out the interest based upon what is the length of the contract or what is the length of the loan. So here we've got $1,000, 6-month, $1,000, 10%. So if we multiply 10% times 1,000, that comes out to 100, but that's for a full year. That would be a full year. So then we multiply it by how many months? 6 over 12, or 1/2, right? That makes sense. 50. So here, C45, it's just recognizing that you understand how to calculate the total interest on the loan based upon the interest rate and the length of the loan. What is the repayment? If this was all within 1 year, this is the C level, and that's why I give the dates April 1st to October 1st, then it would just be the repayment of the loan. The loan would be a notes receivable. We borrowed $1,000. We're going to pay interest, And from the loaner's point of view, this is interest revenue, right? We're being paid interest. So $50. And so the cash we're getting is the repayment of the loan plus the $50 of interest. Now, of course, in the B and A level, we look at a loan that goes over the end of the year from, say, November 1st through May 1st. And that requires us to do some extra stuff. But just for the C level, this is all we need to know. We just need to know how to calculate the total interest and how to write the journal entry for the repayment, which is interest revenue, repayment of the notes receivable, and receiving the cash. And that's all the C levels. Let's go ahead and take a look at some of these A levels. Or I'm sorry, let's start off with the B levels. The A's and the B's. Okay, so for Chapter 7, now you'll notice here that I've got a few things in blue. What ends up happening is because it's a new textbook and whatnot, or at least it's a new textbook for me, I've used several other publisher textbooks. When I'm making up a new exam, I'm making these all from scratch, and so sometimes I will have misworded a few things, like you just noticed me. I said that was kind of bad English, but the information was correct, whereas here I had the wrong something or other. So what I do is whenever I post an update, I will say, the prep document version 1.1 or 1.2, and I'll highlight in blue what the things were that were changed. So here, B2 actually wasn't wrong, but I wanted to match the other ones because B1 through B4 are sale of merchandise or purchase of merchandise. So that wasn't that big a deal. Here, I actually had the wrong journal name just because I wasn't paying attention. Anyway, so sale of merchandise for cash is the cash receipt. Purchase of merchandise for cash is the cash payments. Sale merchandise on account is the sales journal, because on account is the sales, on account is the purchases, because we're tracking AR in this one and AP in that one. Okay, so what are the B level calculation questions? So we've got the first one is just is a fairly simple one. It's just recognizing that the individual customers should add up to be the control account or the main account. So a company has a balance in its AR account of 500 with subsidiary ledgers of customer A and B. What is the amount? I don't even know. I think that was supposed to be of. Ooh, and it's not, customer's not spelled correctly. How did I miss these? What is the amount of customer C's, or maybe that was in. What is the amount in customer C's subsidiary ledger? Okay, well, if 500 is the total amount, we've already got 220 and 190 for customer A and B. Well, we're assuming that there's no customer D or anything else. So we just say, okay, 500 minus 220 minus 190 should be what's left over is in the, because the three customer accounts have to add up to the main account. B6, the beginning balance in a customer's subsidiary AR ledger is 300 with credit sales of, okay, so here we're just trying to remember what increases and what decreases an ART account. So AR is an asset, and so asset has a normal debit balance, meaning debits increase and credits decrease. Remember, this is when we make a sale on account. We record a credit for sales revenue and a debit to AR that we collect at some point. So if it says we had a beginning balance of 300, and it says with credit sales of 120, remember credit sales are debit AR, credit revenue. So whenever we make a credit sale, we're increasing the AR account. So here this would be an increase. And then it says collections of 150. Remember, when we're collecting AR, we're collecting the cash. People are paying off their account. So this would be a reduction of AR and an increase in cash, but the AR part of it's a reduction, so 150. And then returns are also a reduction on AR. Instead of cash, it would be sales return and allowances, if you remember going through that process. So this would also be a reduction. So here we've got a beginning balance plus 120 of the new credit sales, minus 150 of the collections, and minus 40 of the returns. Okay, what are the AR, the A level? As you notice, there's a couple of knowledge-based questions. And like I say, knowledge-based questions, I won't go through in detail. You can read those yourself. What is the ending balance of AR account if the beginning balance was 200? Okay, so this A5 and B6, or I should say A5, A6, and B6 are kind of related. They're basically do you understand what makes an AR account or an A6? In A6 is what makes an AP account goes up. Just the additional extra thing is, while in B6 I tell you credit, sales, and collections, you have to know where those things end up in which journals. So for AR, we really only have to pay attention to two things. Sales journals is equal to the AR, new AR. So this increases. And then cash receipts. So like the sales journal is this one, right? And the cash receipts is this one. So we only really need to focus on two for AR. And so in this case, AR will go down because we're collecting cash, and here we're making a new sale. So that's the additional information. As far as A6, if we wanted to look at AP, again, they're only really focused on two journals. Purchases are an increase to AP, and cash payments are a decrease to AP. And AP doesn't worry about the sales journal, the cash receipts journal, just like the AR doesn't worry about the purchase journal or the cash payments journal. Okay. Oops, I got to make sure I'm keeping this in the camera focus. Let's go on a little bit further. A6, 8, B level 8, and A level 8. Okay, again, you can see all of 8. B level is just the first 3 are on the fraud triangle, and the second 3 are on types of internal control. You don't have to know every type of internal control, just these 3. I've selected 3 that I think are kind of important, and I'll test one of them. The A-level questions, let's see, what do we have here? The A-level questions have to deal with 2 things initially. They have to do with the bank reconciliation, if you remember that process, and they have to do with the petty cash. So we did homework items on both of those, and those might be a little difficult, but just realize these are A-level questions. So essentially what the A-level questions is, if you're, and I didn't do the full bank reconciliation. I only did, you can't do a whole one of those in a test. You have to kind of break it up in parts. Just remember, for example, A7, it says, what is the adjusted cash balance per the bank? And then A8 is, what is the adjusted cash balance per the books? So the main thing here you have to remember is when you do the adjusting, so adjusting the books versus adjusting the bank statement. So adjusting the books, you want to find the things not in the books and add them or subtract them as necessary. And those will be found in the bank statement. So let's look at A7. Beginning bank balance is 800. And it says outstanding checks are 240. Well, outstanding checks are written from the company, so therefore they're already in the books. Just like deposits are written from the company and are already in the books. Now, they may not have shown up in the bank statement yet. That's why they're called outstanding checks or deposits or transfers. But they're already in the books, so therefore we don't need to do anything for them. But it says bank service charge. Well, that's something from the bank. Oh, I'm sorry. Here, I said, I'm looking at A7. It says, what is the adjusted cash balance per the bank? Okay. Well, let's keep doing this because I'm correct, but let me just make this A8. I was just reading the wrong one. A8, what is the adjusted cash balance per the books? Beginning book balance is, instead of 800, 500. And it says outstanding checks are 240. So same thing. Those are already in the books. We write the checks from the company books, and therefore those are entered as soon as we write them. They may not be in the bank statement yet. That's the problem. Interest earned is 40 and bank service charges are 70. So these are 2 things, interest earned and bank service charges, that we don't have in the books but are in the bank statement. So we need to say, okay, interest earned, well, that's additional cash. And then bank service charges, that's cash going out. So the outstanding checks are already in the books. We don't need to change. The books already, that $500 already includes written checks. What it doesn't include are things on the bank statement, i.e. the interest rate and the bank service charge. Now let's go back and look at A7. So this is the adjusted cash for the bank. So what we're going to look for is things on the bank statement are already, the bank is already taken account for. What they don't know is they don't know outstanding checks, and they don't know deposits in transit. So basically, from the bank point of view, it's very simple. There's only two things typically they don't know: outstanding checks and deposits in transit. Whereas there's a whole bunch of things that the books may not know: service charges, EFT payments, EFT receipts, non-sufficient funds. There's a whole list of things. So there's a whole list of things that we need to adjust the books by, but very few things that we adjust the bank by. A9, the petty cash. Basically, what needs to add up is you're going to have your receipts, and you're going to have your cash left in your petty cash fund. Now, if those equal the total cash, you're okay. So in other words, if this was 70 and 30 and your total cash was 100, you'd be okay. But what if this is 70 and the cash in the fund is 28? Well, 70 plus 28 doesn't equal it. So what ends up happening? You're short $2. Well, when you need to ask the company to put more cash into the fund, you don't ask them to just put in money for the receipts. You ask them to put in money for the receipts and what you're short, right? Because just asking them put in 70 only gets you back to 98. But by asking them for 70 plus the 2, that gets you back to the total cash. And that's essentially what A9 and A10. A9 is asking you is how much is short. A10 is what's asking you what's the total amount that you need to put back. And then A11, A12 are just done knowledge questions. Last chapter, A and B. There's a little bit more information here, although I'm going to point out that they are, let me put this over here, that they're going to be matched. So I'm going to kind of describe them as as they're matched. And what do I mean by that? Look at B13 and A13. B13 is a knowledge thing, a factor in a finance company, this, that, and the other. And then A13, I ask you a number question for a factor. Accompanying factors, it's AR with a balance of 1,000 for a 3% factoring fee. Well, just think of the factoring fee as if you sell off your AR to a company that's going to collect it for you, but you want the cash early, they're going to charge you a little fee. So if they charge you a 3% fee, well, how much are you going to get for your $1,000 of AR? Well, $970. B14 and A14, both of them are credit card payments. One is, and they're just, flip sides of the same coin. It's the same calculation. And again, we're still talking about a charge. So if we sell something to a customer for $200 and they're going to use a credit card, well, the credit card company charges us, the retailer, 2%. So how much is that? Well, that's $4. Just remember, it's a $4 debit, right? Because if I wrote the journal entry, it would be I made sales revenue of $200, but I'm not going to get all that in cash, right? What's going to happen is we're going to have a service charge, which is a type of expense, right? And expenses are debits. 2% of 200 is 4. And how much cash are we actually going to get? 196. So this is asking a little bit more of a difficult question, not just that it's $4, but it's a $4 debit because it's an expense. It's a service charge expense, and expenses are debits. The other part of it, A14, is just saying, well, how much is the cash part? So all I've done is ask you the two different parts. B15 and A15, again, it's the same question, just two different parts of it. If a company has a beginning balance in ADA, so remember, we already talked about knowing that the adjusting journal entry is based upon the beginning and ending balance of ADA. Well, here, we still have $50 as our beginning, but instead of just doing a straight percentage of AR, remember we had $1,000 of AR. Well, here, what we've done is, and I didn't actually put $1,000 into it. I only have, $400. But let's say we've got $400 in our AR. What we do, instead of just doing a certain percentage times AR, we actually break out the AR into how overdue it is. Well, less than 30 days, it's not overdue yet, so very few people default. 1 month overdue, it's a slight uptick in default, but not that many. And then 2 months overdue, there's a lot more people that default. So what do we do? 2% times 100, 10% times 200, and 50% times 100. Well, what does that come out to? That comes out to 72. But remember, that's not our adjusting journal entry. That's the new ending balance, right? This was the same question that we asked on the C level. We just have a little bit more sophisticated method of calculating this. So this is going to be the new ending balance, right? And that's what B15 asks. And then A15 asks, well, what is the adjusting journal entry? Well, the adjusting journal entry is 22, right? That's what makes this go through. What is the bad debt expense? So it doesn't specifically say journal entry, but the journal entry is bad debt expense, 22, and it's the allowance for doubtful accounts, 22. B16 and A16, let me see, are these two? I think I was off by one when I matched these up. This is just a knowledge question. What do we get when we take AR minus the allowance for doubtful account? It's called the net realizable value. What is okay, so maybe it's B17 and A16. I think I didn't have those matched up quite right. So B17 and A16 are both about the loan. So when we have a loan that crosses the end of the year, it's all going to be done relatively the same, but we just have to worry about that ending entry. So what happens is if we have a loan, this loan goes from November 1st to May 1st. It is still 6 months, and it's 1,000. We've changed the dollars so that it works out a little better. 10%. So what's 10% of 120? But remember, that's for a full year, and we're doing a half year, so the total amount's going to be 60. Now, what's happening? Even though November 1st to May 1st is 6 full months, all of November, December, January, February, March, April. So those are 6 full months. And if it's 6 full months, what we have is it's $10 per month, right? Well, how many full months are in going from November 1st to December 31st? Well, it's all of November and all of December. So essentially what we need to do here is, because this loan falls over 2 different years, we have to, let's say 11/1/22 to December 31st, 22, 22, and then we pay it off on 5/1/23. Well, this total amount is going to be 6 months, and therefore it's going to be $60. But what about this amount and this amount? Because it's in 2 different years, we actually need to split up and record the interest revenue, because remember, it's important for us to record the revenue in the period that it was earned. Well, this is 2 months, and we're saying it's $10 a month, so we're going to record $20 of revenue here, and this is 4 months, so we're going to record $40 of revenue there. Well, how do we do that? Well, that's what B17 and A16 are asking. So B17, it says, what is the end of year adjusting journal? Well, we're recording $20 of interest revenue, so that's a credit of interest revenue of, I forgot to change that one. So I forgot to have it. So I've got to change that one again, don't I? So it should be interest revenue of 20 and interest receivable. And the thing is, I think most of you haven't even looked at these yet, so it's not going to be a big deal for me to change it. Now you notice I say receivable because they don't pay the interest until the end of the loan. So what we're saying is, all we've done is really for our own purposes. The customer doesn't really care. For our own purposes, we're just saying we recorded $20 of interest in this year, and they haven't paid it for us, so we're waiting for them to pay us. That's why it's a receivable. Now, when we get to the end of next year, the end of the loan, well, we've recorded the first $20, and now we need to record the next $20, and that's what A16 is. And you can see the blue that I changed it there. So they're going to pay off the loan. So the loan was $1,200, right? And They're going to pay us the loan plus all the interest. Well, the loan plus all the interest is $60. And we've got two things we need to look at here. Well, we need to record the rest of the interest revenue, right? That $40. Remember, we said it was going to be $20 and $40. So we need to record $40, but that still doesn't make things work. Well, if you remember, we had that interest receivable hanging out there, right? At the end of the year, we had that receivable saying we recorded $20 worth of interest, but we haven't received it yet. Well, now we're receiving it. So we get rid of that interest receivable, and that's what A16 is. Let's see, B18 and A18 are both knowledge-based questions, and A17 is just a relatively I put a lot of times in the A-level things that are sort of niche questions. They're not really primary parts of the chapter, but we include them in certain sections. A17 is one of those. How to recover, let's say you wrote off an amount, how to recover it. So if we wrote off the amount, we would have written it off this way. So this would have been the write-off. ADA 500. We would have written down the AR by 500. And if we wanted to recover it, well, recovery means the customer popped back up and said, we want to continue doing business with you. We said, well, you got to pay off your previous amount before we start doing business with you. So the point being is a recovery involves the customer paying off the account, not just us reinstating the account. So the first thing we need to do is reinstate the account, right? Okay, we're just going to reverse this, right? We'll put it back into AR saying you still owe us, and we'll put this amount back into ADA. And now what we're expecting is if they pop back up, we say, well, go ahead and pay us. Otherwise, we're not going to do this. So they're going to pay us the cash, and that's going to get rid of the AR. And so that's what the recovery is. It's reinstating the account and then receiving the cash to pay off the account before we continue doing business. Okay, that's all I've got. If you have questions, let me know. I'm going to make a couple more changes to some of these items here that I know that some wording, and obviously this B17, I need to change that to a $20 amount. Okay, good luck. If you have any questions, I think the window opens Saturday through Thursday, so you still have some time to finish up the homework and do the quiz. Please do the quiz and get everything ready. Okay, have a good one.